By now, you would have definitely heard the phrase mutual funds sahi hai. You would have probably also heard SIPs sahi hai. If you have wondered why that is the case, this video is for you. In this short video, you will be able to understand the basics of what moves the markets and which are the moves that you should really care about. There are two main factors that cause markets to move. Number one, productivity growth. Over time, as economies grow, the total amount of productivity in the economy also grows, which means that at any given point, more goods and services will be produced in the future as compared to today. Companies, which are the most basic unit in an economy, also grow over time with higher productivity and profitability. This in turn leads to a rise in company value as well as their stock price. If markets relied purely on this factor, there would be a steady growth in the value of the overall markets. Number two, impact of human emotions. In a financial market, this refers to investor sentiment, which is characterized by volatility. Investor sentiment can be impacted by several socio-economic and political factors and can cause major fluctuations that we see in the markets over the short term. However, over time, the abnormal positive and negative fluctuations smoothen each other out to result in a normalized outcome. We don't really need to look too far back in history to see this manifest itself. In 2020, when the pandemic struck, stocks plunged as much as 30 to 40% immediately. However, the central banks came in to ease monetary policy and caused stocks to roar back up as fast as they had plummeted. Fast forward to 2021, when there were concerns of growing interest rates and stocks started to show volatility again. While it has been a bumpy ride, the ups and downs in the markets have smoothened out over time and the broad market indexes have continued to grow steadily. The bottom line is that as long as the overall productivity in the economy rises, with innovation as fuel, the markets will rise. And the growth of productivity has been a constant ever since the existence of the financial markets. Hence, if you just invest the same amount periodically in the same portfolio, you would essentially average out your buying price and negate the impact of short-term volatility on your portfolio, thereby earning the profits from productivity growth. This is exactly what SIPs help to achieve. We are talking about 10 to 12% annual productivity growth as long as the holding period is at least 8 to 10 years. Stay calm and stick to your SIPs. They will definitely pay off in the long run. Selecting your funds for your SIP? At Cashvisory, we are doing just that by curating custom portfolios for you using Nobel Prize winning algorithms. Stay tuned.